Welcome everyone. Kia orana, tātou katoa, tēnā koutou katoa. Welcome to the Reserve Bank's Monetary Policy Statement, and in honour of the Pacific Language Week, no ia, which is Rotomā language. I'm joined here today with Jeff Bascan, the Deputy Governor, Yung Ha, our Chief Economist, and Christian Hawkesby, our Assistant Governor, here to answer questions. Prior to getting into question time, I do want to just provide a brief statement. The Monetary Policy Committee today has agreed to significantly expand the large-scale asset purchase program that we are undertaking up to $60 billion, which is up from the $33 billion level that we have shifted from. The LSAT program includes New Zealand government bonds, local government funding agency bonds, and now also government inflation index bonds. The global economic disruption caused by the COVID-19 pandemic is expected to persist and lead to lower economic growth, employment and inflation both in New Zealand and abroad. Even if New Zealand successfully contains the spread of the disease locally, reduced world economic activity will mean significant reduced demand for New Zealand's goods and services, our exports. The Monetary Policy Committee is committed to achieving its employment and inflation objectives. The main support for the economy in this very, very unusual environment is coming through appropriately from increased fiscal spending, which I know we will all hear about tomorrow. However, monetary policy will continue to provide significant support through keeping interest rates low for the foreseeable future. The balance of economic risks still remain to the downside. The expansion to the LSAT program aims to continue to reduce the cost of borrowing both quickly and sharply. This is preferable to delivering a smaller amount of stimulus now, only to realise we have to do more later. We expect to see retail interest rates to decline further as lower wholesale rates are passed through to the bank customers, and it remains in the best interests of the banks to pass through fully and maximise the effectiveness of our large-scale asset purchasing program. The official cash rate, the OCR, is being held at 0.25%, and this is in accordance with the guidance we provided at 16 March. But the Monetary Policy Committee remains prepared to do whatever it takes to ensure that we have significant monetary stimulus in the economy. We can use additional tools if and when needed, which includes reducing the OCR further post the March date, adding other types of assets to the LSAT program, and providing fixed-term loans to banks. These committees' decisions will be guided by our mandate and, of course, our decision-making principles around the use of the alternative monetary policy instruments. Mai taki mā, thank you very much, and we are now open for questions.
Sorry, we'll start off with Katie Bradford from TVNZ.
Hello. I'm assuming you can hear me there now. When you talk about the banks passing the interest rates on, how low do you think they can go, and how much pressure would you like to put on them to actually send them lower?
We don't put pressure on them. It should be a competitive market and they should be pressuring each other. When we talk about negative rates, we are talking about wholesale interest rates. We're not talking about retail interest rates. And we just note and spend a bit of time in our document saying we can rationalise why the current lower wholesale rates have not been fully passed on. But as credit demand improves, as competition returns to the banking sector, we expect to see the full pass-through of the interest rates to retail land.
Matthew from Kanga News.
Thanks, Oliver, and thanks, Adrian. I just wanted to ask why the Reserve Bank opted for the inclusion of inflation index bonds into the asset purchase program over, for example, other government sector securities. I know there was a lot of speculation in the market as to whether Housing New Zealand securities would be included. So just wanted some clarity on why the Reserve Bank chose this path instead.
There are a couple of reasons, and I will go across to Christian Hawkesby in a second. But really, we are following our principles that we outlined around the use of alternative monetary policy tools. And that's largely around the effectiveness, the efficiency side, and the inflation index linked bonds are obviously a core part of the government debt issuing program. They give us further purchasing scope, and also a secondary outcome can be to improve the efficiency. Christian?
Yeah, that's right, Adrian. We started with the nominal government bonds because they are the largest part of our fixed interest market. They're the most important benchmark and the most liquid part, and so that's where we started the LSEP program. We added local government funding agency bonds because they are a key benchmark for corporate bonds, and providing liquidity there and pricing points is important for the transmission of monetary policy. For inflation index linked bonds, I think a key consideration there is on efficiency grounds, supporting the functioning of that market and ensuring that we aren't creating undue distortions between nominal and inflation linked bonds. Thanks.
Next question here from Lachlan from Market News International. Lachlan.
Yeah, thanks, Adrian. I'm just interested in your thinking on negative interest rates. You seem to be preparing the market for negative interest rates. Just interested in knowing if you have a timetable, what the scenario is for implementing them and enacting that.
Yes, thank you. I mean, the real challenge for us is to make sure that all options are available. One hopes you never have to use all options. We are very pleased with the effectiveness that our LSAP, our large-scale asset purchasing program, has had on both lowering the level and also flattening the yield curve. But why shouldn't we also retain an optionality to use the traditional price tool if further stimulus is needed? We will be assessing the use of negative interest rates along with the other tools I mentioned. So there's going to be, the first question will be, do we need further stimulus? The second question will be, in that period, what would be the most effective and most efficient means by which to add it? Further additional instruments in the LSAP, term lending, and or negative wholesale interest rates, or the official cash rate.
Thank you.
The next question, Brian Fellow, NZ Herald.
Hi. You seem to be reluctant to go beyond holding more than 50% of the government bonds on issue. How did you arrive at that number? And is it a constraint that you're starting from a position where there's only a relatively small amount of government debt on issue as a starting point?
Two very quick answers. The first one is, we want the bond market to have more participants in it than just the central bank. And we think at around 50%, we give market players sufficient certainty that there is liquidity, that there is activity going on in the bonds that we are not holding. So the market is still functioning, remaining, and providing good price signals. The second bit around constraining our future, as you know, the government is in a significant fiscal expansion period, and I can only assume, which we have done from publicly available information, that there will be a lot more bonds on issue. And in addition, there are alternative instruments as well we can consider purchasing. So it's about market functioning while also allowing us to provide the monetary stimulus.
Thank you. Next question, Janae at interest.co.nz.
Thank you. I'm just wondering, how ready are bank systems for negative interest rates? How much progress have they made getting ready?
I'd like Jeff Bascat, our Deputy Governor. Jeff?
Thank you. Look, it varies across the banks. Some of them are more ready than others. What we've done is written to them and asked them to get themselves ready by the end of the year. We are monitoring their progress. It is a level of complexity with different banks in terms of their systems, and of course they are all having competing demands on their people and their IT departments and so forth at the moment with the COVID restrictions. So, you know, we're conscious of that, but we've asked them to be ready by the end of the year, and that letter is available on our website.
Thank you. Next question, Madison Reid from News Hub.
Oh, it says that I'm muted. No, I think you can hear me. When it comes to unemployment, where do you expect that to peak? I know that it's in your forecast, but it would be great to get you saying it. And what is that outlook actually pending on?
So we've provided 3 scenarios in the document, and we say scenarios. We try to stay away from forecasts because the outlook is just so uncertain. And we see unemployment ranging in those 3 scenarios between 9 and 12% at the peak. So the base scenario, the one that we talk most about, is around a 9% unemployment peak, but you know, huge bands of uncertainty around that. So between 9 and 12%, which we see as broadly similar to where the New Zealand Treasury has come out, and very similar, I would say, to where many OECD countries are also projecting the labour markets to be.
Thank you. John Mayer, do you have a question?
Yeah, Governor, just in the minutes, you mentioned that you're looking at all tools for monetary policy, including potentially buying foreign assets for the asset buying program. Are you concerned that that may raise issues of other countries seeing you as manipulating the currency?
I think that's always a challenge. You know, it is a one tool. One good thing about being in New Zealand, I don't think we particularly threaten other large economies in terms of our competitiveness. So I'm not sure we will create a large currency war, but you know, at the same time, currency purchasing foreign assets is a relative tool. We're saying it is a tool that is available, but it's, you know, it would be selected if and when we ever thought it would be effective.
Next question from Thomas Coughlin at Stuff.
Hi. What would it take for you to start purchasing bonds on the primary market?
I suppose dysfunction in the secondary market and a need to continue to stimulate monetary policy. At present, we are a long way away from that. We've been very, very pleased with how well markets are functioning, and the feedback we've received is that they are very pleased that we are in doing what we are doing.
Any other further questions? Stephen Wright.
Is a negative cash rate, is that a possibility within your 3 main scenarios, or is it something that we would only see if economic conditions and unemployment were worse than those scenarios currently imagined?
I'd like to pass over to Jung, in part because he's got himself ready and hasn't been allowed to answer a question. Jung?
Thanks, Adrian. I guess hypothetically, all tools are actually open under if we need to provide more stimulus rather than just the negative cash rate. As we say, the Monetary Policy Committee is committed to our remit, full employment, low and stable inflation. We are currently expanding stimulus through the LSAT program, but if we require more stimulus and economic conditions worsen, we would consider all tools using our alternative monetary policy principles to guide which ones do the best job for the situation at hand. Thank you.
Next question here from Matthew Brockett from Reuters, and then we'll go to Praveen after that. Having a bit of trouble hearing you there. Sorry, Matthew. We'll try Praveen and we'll come back to you, Matthew. Praveen, did you have a question?
Yep. Hi, can you hear me?
Yes. Yeah.
Okay. Yeah, just a quick one on the fiscal spending. In the statement, it talks about there being appropriate fiscal spending. What is the expectation in terms of the spending going forward by the government, and how would that change or influence monetary policy for the bank?
Yes, a very good question. Thank you, Praveen. And what we have assumed in this document, which is how we always roll being an independent central bank, is we have used the publicly available fiscal information, which is around another $52 billion in additional spending, and that comes on top of the $12 billion infrastructure spending that was announced in December of last year. So that is the underlying assumption, and then we put that assumption into our economic forecast and then say what else would monetary policy need to do for us to be able to meet our mandate. In terms of the type of spending, we made the very scientific suggestion, because they've already done 20 billion of the spending. So for the additional 30 billion, sorry, mixing my numbers up here, we've just done a third around in investment, consumption and transfer payment. Christian, can you correct me if I have misled anyone?
No, that's right. Nothing to add there, Adrian.
Okay, thank you.
We'll try Matthew Brockett again at Bloomberg. Matthew. Still seem to have some audio issues. We'll try again. Thomas Coughlin, did you have another question?
I didn't actually, sorry. I must have raised my hand in error.
That's all right. Madison Reedy, you had a follow-up question.
Describe, oh, I'm unmuted. Sorry, I'm just going to get this off my screen. There we go. Adrian, how would you describe this economic situation that both we and the world are in at the moment?
A very difficult situation, and I know the word is overused now, but unprecedented in modern economic time. To have such a sudden and one-off global stop to economic activity, or effective stop, you don't find many examples of that in the history books. So it's an interesting time. But having said that, I do think that the global economy and economic policy and our starting positions are very good and well suited to be able to manage our way through the economic activity. But it will take significant spending. It will take a lot of confidence to be retained in the international economy. And we will have to be doing business differently. So without doubt, the next 12 plus months are going to be very tough for people, and we will have to support each other, get out there and support each other.
Our next question, Rebecca Howard at Business Desk. Rebecca.
Can you hear me?
Yep, you're good.
Okay, I just wondered, the baseline scenario talks about being at alert level 3 and alert level 4 for 4 weeks each, and at alert level 2 until March 2021. And I just wondered, is there a possibility that it could actually be better than you're expecting? Because we were under alert level 3 for only 2 weeks, and there seems to be chatter about moving to alert level 1 quite a bit sooner than March 2021. So that was one of my questions. And the other question was, are you comfortable with where the exchange rate is now in terms of helping support an export-led recovery, or would you like to see it lower?
Thank you. On the first one, without doubt, we have just had to create scenarios. And so, you know, when we were putting together these scenarios, we mixed up the level 4, 3, 2s, and even 1s. And without doubt, there are upside to those scenarios. We don't see the upside as being significantly outweighing the other downsides, however, which we do. What are some of the upsides? There's been talk about a trans-Tasman travel bubble, potentially with the Pacific Island nations included. That's an upside. Our terms of trade, our export prices, our agricultural production has been holding up well. That's an upside. Education as part of our tourism earnings. There's new ways around and and movements there. So these are all upsides, but they are small relative to some of the other downsides we see, which is related to effectively large global trade reductions, and we are a trading nation. On the level of the exchange rate, we don't have any influence over that. We just really hope that people are thinking about relative inflation between countries, relative competitiveness, and I see it's come off today, and that's people's perceptions. Yong, do you want to talk about the scenarios?
Yeah, I mean, the Trans-Tasman bubble is something we discussed briefly, and possibly the return to alert level 1. But yeah, they are upsides, but it's probably not significant in the context of the broader downside risk we're facing around second waves, the possibility that global demand will continue to be much weaker than we've assumed in our assumptions as well, and then even possibility that the vaccine will take longer to actually come to market. So those are all things weighing on our decision at this point in time.
Our next question, Matt from Kanga News. Matt.
Sorry. I just had a question on, given New Zealand government bond yields have reached record lows in recent weeks, which has obviously been one of the key goals of unconventional monetary policy, but has consequences for offshore investment, particularly as that they might be lower than some larger sort of offshore jurisdictions. Is any consideration given to the fact that offshore investment might be affected from those rates staying extremely low?
This is one of the challenges of longer-term interest rates. The wonderful thing about the official cash rate is we can control that price directly, but the further you shift out the yield curve, a whole set of other influences can be involved around risk premia, relative interest rate differentials between countries, and our efforts are only one part of that whole program. But to the extent that we are purchasing more, we are certainly creating more demand for the bonds, and hence the yields are falling in a very in the manner that we were really hoping for them to be achieved. I would say most of international investors, they're going to be thinking a lot further beyond just current relative price. They're going to be thinking about long-term relative economic gains, and I would say New Zealand sits there in one of the better positions around having contained and being in a position to recover. But going a bit too far there, Christian, concerns?
We are conscious that yields have fallen a long way. That has been a key goal of the committee, to keep yields low and to keep markets functioning. If there are some investors out there who are reliant on the yield that they receive from their fixed interest instruments, and New Zealand yields are getting too low for them, then if they're selling out of those securities, that will put downward pressure on the New Zealand dollar, and that's another channel by which our monetary policy can work and effectively flow through to higher inflation and stronger employment.
Great. Next question, John at Reuters. You're just on mute there, John. If we can just wait till you've come on mute. We'll come. Oh, there we go.
Okay, is that better?
Great.
Yeah, I just wanted to ask about the near-term forecasts on GDP. There's obviously a very sharp contraction in the current quarter, around 22%, but then you've got a snapback of about 24% growth in the September quarter. Is that what people refer to as a V-shaped recovery? And what exactly will drive that, given isolation from the rest of the world is likely to be in place, through the rest of this year?
I'll let Yong talk about the technical aspects of the significant volatility in GDP, but I will just say at the outset that's not a V-shaped recovery. That is much around the statistical fact that you stopped activity and then we've turned activity back on partially, but there is still a long period of economic recovery. We don't get back to the current level of GDP until 2022. Jon?
Well, that's right. The V shape largely is just the arithmetic. We locked the economy down for 4 weeks in level 4, a little bit of time in level 3. So when we've come out of that, you see a bit of a pickup in activity. I wouldn't call it a rebound. It's simply people are able to go out, spend again, but activity certainly remains below the level it was at the start of the year before the lockdown happened, and it stays below that level for many years. So it's a very slow recovery.
Next question, Janae, interest. Did you have another follow-up question?
Thank you. I just note in this scenario there's deflation by next year. What would you say to people who might look at that negative figure and say that actually more needs to be done in terms of monetary stimulus?
Very good question. Thank you. And really, it's about the horizon over which we can have an influence. Again, I don't want to sound too trite around the statistical sides, but the good news was we started in a positive 2.5% inflation. We can't really influence the final level of inflation for at least 12 to 18 months down the path, so we're always working ahead. This shock has come in between, and so, the next 2 to 3 quarters, we don't have much influence over those numbers. So really, it's as much as saying it's happening, and our monetary policy has to remain focused further out. Are there any specific technical reasons as well, Jon, for the?
Yeah, we expect inflation to print negative in the June quarter, and largely that reflects the massive decline we've seen in international oil prices. So that will feed through very quickly. But as Adrian says, looking at the medium term, we are looking at low inflation, but it won't be negative. It will sort of be in the 0 to 1% annual rates of inflation. So we're focusing on getting that back to the midpoint of our target.
Next question, Bernard Hickey in Newsroom.
Governor, could you give us a sense of why you've chosen to increase the asset purchase program to $60 billion rather than giving direction to the market about a certain level for government bond yields, which are now down to 0.5% or so?
Yes, thank you, Bernard. I think, and the very short answer is it's very, very hard. We don't have the full influence over targeting a specific level of an interest rate, a longer-term interest rate, because we are but one player in the whole game. Obviously, we're a large player and we've just become larger, and we want to remain in that position where we are keeping the interest rate yield curve both flat and low, and at least as low, and if not lower than where they currently are. But it would be spurious for us to claim we are targeting an exact number when we don't have the tools to do that. We certainly have plenty of broad estimates of monetary stimulus, and so we can get observe as we go on the purchasing around our impact on the interest rates.
Next question, Brian Fellow, NZ Herald.
Janae is. Hello, can you hear me?
Yep.
You're good, Brian.
Okay. Janae actually asked the question I had in mind, but I have another. I mean, when it comes to considering negative rates and where the effective lower bound is there any kind of constraint that New Zealand banks are so reliant on importing the savings of foreigners? Is that a limiting factor in how negative you can go?
Yes, there are limits, but it's very hard to tell what the limits are in advance. Again, it's going to be one of those learning by doing. Should we decide that a negative OCR is an effective path and necessary, there will be a limit to that. Part of that limit is that people actually get a little bit annoyed having to pay to keep their money in the bank and start, potentially just hold cash. Other types of limits are that banks want to attract and retain deposits. So retail deposit rates generally stay positive, and so the wholesale rates could come down, but the retail deposit rates, which are an important part of the funding of banks' activities, can be a constraint as well. But those constraints are significant, below zero, and at the moment we're above zero. So there is still petrol in that tank, effectively.
But specifically, the degree of dependence on foreign funding, is that a constraint that other central banks might not face?
No, it's not. Christian, do you want to just chat about that?
Yeah, I think we have the ability to set the official cash rate as the central bank, and that's the overnight wholesale interest rate. I think where your question comes in is, to what extent do foreigners want to fund our banking system, which really relies on where is it that our banks can go to market and raise funds internationally. And that tends to be driven by where the official cash rate is in New Zealand, and then a premium that they have to pay in the market to gain access to funding. So we think that bringing the official cash rate down, that's going to drive down this benchmark level, and in doing so, it will drive down interest rates right across the economy for households and businesses whose interest rates are set as a margin above the official cash rate.
We have time for a few more questions. The next one is Andrew Patterson at Newsroom.
No, I don't have a question, sorry.
Janae, you had your hand up. Sorry, Janae, and then Bernard to finish it off.
Thank you. Just a question about bank lending, and I guess acknowledging the fact that is a key part of the economic recovery. Governor, you've previously said that banks need to be courageous with their lending. A couple of things. I'm just wondering, do you have preliminary data for April to show us what lending to businesses has been like? And how confident are you that they are actually lending enough?
Yes, thank you. Good question as well again, Janae. We've been very, very focused and working very closely with the banks around their lending activity. It's there's a combination of both their willingness to lend and also people's willingness to borrow. And it's been certainly weaker on the other side, but the stats are showing continued credit growth. And I'd probably pass over to Jeff to talk specifically. Jeff?
Well, look, I don't have specific data on the actual credit numbers that you're asking about, Janae, but as the governor said, I mean, the reported story from the banks is credit demand's quite low. The wage subsidies made a huge difference to cash positions for businesses over the initial period, and so that's helped them to fund costs. Of course, it won't last forever, and they will need to both borrow and also get revenue in so that they can actually start to pay bills as time goes on. But for now, there's been sort of restructuring of some loans. There's been extensions, if you like, and things like that, but not a huge amount of new credit growth. Just some signs it's starting to open up a little bit in our discussions with them. A little bit of inquiry going on in the housing market again. Big picture, yes, banks need to lend to support the economy. That's absolutely right. The worst thing we could have would be a credit crunch that would come on top of this recession and really slow things down further. So, them being willing to support customers and to look for opportunities would be very helpful for getting us back on the growth path we need to be.
Thank you. Do you mind if I just ask a follow-up question to that?
Sure, Janae, you have a follow-up question from Janae there?
Thank you. I mean, banks are no doubt a little bit constrained by their responsible lending requirements. Is any consideration being given at this stage to the Reserve Bank actually writing loans? I mean, I know the IRD is writing loans for smaller businesses, but are we thinking about the Reserve Bank actually doing that?
At present, no. What we are doing is we are writing loans to the banking sector, who are then, i.e., they are providing collateral. We are giving them cash, and we are encouraging them to be courageous, to use their capital, to use their customers, and have plenty of access to the liquidity they need to do their business. So we bank the banks bank the people, and that's been the main challenge. The small business cash flow scheme you're talking about, that is where you're going direct to providing some small loans via the Inland Revenue, which is a fiscal policy. It's not part of the monetary policy tool set, but we're here to facilitate. So one of the tools we're considering or have on the table is the term lending facilities, where we can provide direct term loans to the banks. So really, it's about us making sure the banks are fit for purpose and the banks are behaving as we would want, and not adding to the problem, but assisting in getting out of the problem. This is also why we've talked about fiscal policy being the obvious and appropriate, most important tool that is being used at the moment, because there you are directly going into spending, investing, and you're relying less on intermediaries, competitive intermediaries, to deliver the product.
Time just for two more, I think, Bernard, and then last question from Madison Reedy. Bernard?
Governor, some people have criticised these sorts of programs, quantitative easing programs, as QE for the rich, because they work by lowering interest rates and pushing up asset prices, sometimes as the money received for selling the bond to the Reserve Bank is then put into existing asset prices, stock prices or whatever. How is this asset program going to benefit people who aren't borrowers or are small businesses who don't seem to be able to borrow any money from the banks at the moment?
It will benefit them significantly. First, just as an aside, there are absolute relative, winners, losers, above, below in any monetary policy situation, and the QE isn't any particularly different or more severe or less severe than other monetary policy tools. Savers, elderly, so on and so forth. With the QE, the significant benefit that everyone gets is that spending can continue to happen, so that people continue to be employed, continue to produce goods and services. There's an aggregate demand going in the economy. So it'd be wrong to only count the input. You've got to actually count the generation and the activity, and then all of the outcomes that come from that, which are primarily employment.
Just our final question, Maddie Reedy from News Hub, and then the Governor will wrap up.
Thanks. I just have two, if that's all right. First, how did you land on that 9% possible fall in house prices in the baseline scenario?
John?
Yeah, I mean, this is a scenario, so we're working on broad assumptions here. So we're looking at a world where economic activity will be much lower, incomes will be lower, unemployment rates will be much higher. And then you factor in the fact that migration, which has historically been a big impetus, a big driver for housing market, will be zero or very low for a significant period of time. So in that environment, it's not unreasonable to expect housing demand will fall. And we've got a working assumption that you could see falls of around between 5 and 10%, which is sort of what a range of other market analysts are sort of picking as well. So that's just a working assumption for our projections at this time, or our scenarios at this time.
Oh, sorry, I've just got to take this off my screen. It's happened again. Obviously, this is an extremely uncertain and fast-paced, moving environment. How sure are you that you've got it right? And just how much is the Reserve Bank team having to scramble to get these numbers together and put forecasts together?
The very first good thing about monetary policy is that it's a repeat game, and that we can continue to work on a needs basis around adding or taking away the relative stimulus that we need. It's not a one-shot game. The second bit around scrambling, I think it's actually been quite straightforward, not necessarily operationally. We've been playing the Brady Bunch challenge like you all, trying to do these things over Zoom and other tools. But the real simplicity to this is that the risks are so clear to one side. And so, there's not a lot of debate around what we should be doing, and there's not a lot of finessing about how much should that be. We can get underway and we can continue to observe the impact we're having for monetary policy quite simply. It's been very rewarding, actually, how quickly the team has been able to shift into these alternative monetary policy tools, and very rewarding to see how effective they have been to date.
Thanks. If we've only probably just one last final question then from Bernard, and then I'll leave the Governor to wrap things up. Bernard.
Thank you. Governor, with up to $60 billion and not that many bonds on issue at the moment, how much can you buy before you start distorting the market? And at what point do you say, okay, I need to buy directly, otherwise I keep distorting the market?
Well, the letter of indemnity is that we don't go above half of the total bonds outstanding. That's not a target. That is simply an operational flexible use for us, so that we don't have to go back each week with a new quantitative number if we want to change it. And so that gives us that flexibility. And we think around 50% of the government bond market, 30% of the local government agency and inflation index bonds is sufficient for us to achieve what we need to achieve with, and also improve the market, not distort the market. So that's why we have been there. Running straight to direct buying in the primary market doesn't have to be the next step if we discovered that we needed far more and there weren't sufficient on offer in the secondary market. As mentioned, there are a range of other tools, and we're going to keep an open mind about it. We want full optionality.
Just one final cheeky question. Where did you find the 27 billion? Or are you inventing it?
I don't know if I even want to answer that one. Christian, can you humour that question, please?
Yeah, look, we've just used publicly available information around fiscal spending that we've already talked about earlier, 52 billion of additional spending that was in that envelope announced by the minister, and everything in our projections is consistent with that. The amount of the program, the $60 billion LSAT program, I just need to emphasise that it's not driven by the size of the government bond market. It's driven by the economic assessment of how much additional stimulus is needed, and that's what drove the MPC to that number.
Thank you. I'll let the Governor have the final wrap up.
Yeah, well, thank you very much. I do want to say that it's wonderful to hear all your voices, and that to know that you're all well and healthy. That is a very, very strong starting position for us all. As I mentioned, the monetary policy is a repeat game. The team have done an exceptional work to date. What you've seen around the monetary policy and discussions today is only one part of what the bank has been doing as a whole, facilitating and enabling many of the fiscal policy challenges that are available. I hope you all stay well, and we will see this country Aotearoa through this in a strong and rapid manner. Thank you.